Good afternoon, everybody. Welcome back to Markets for Millennials with the weekly market analysis from June 6th to June 10th. And obviously, the big news today is that inflation rose 8.6% in May. This is the highest rate since 1981. And essentially, this dashed all of the hopes that the market had been pricing in that there would be a pause in the Fed raising rates. Obviously, this month they've also started with the quantitative tightening process. They're removing liquidity from the market. And a lot of people had been saying also that inflation had peaked a few months ago, I believe 2 months ago. And you see here prices rose 8.6%. The core CPI was 6%, which is slightly higher than the 5.9% estimate. On the monthly basis, headline CPI was up 100% and core rose 0.6%. Obviously, all of these things were above estimates, so a lot of things just kind of cascaded from there. And what I noticed, and I don't always just look at CNBC, but it's just easiest to look here, just on their front market page. If you go to the website, sometimes it's fun to just take a look through the main stories that are being posted. And one caught my eye, and right here in the middle. I don't have the ability to actually open this article, but I just thought if you see where I'm circling on my mouse and kind of highlighting, some economists predict the Fed will hike rates by as much as 75 basis points next week. And this goes to something that I have been talking about on Twitter for a little while, that I don't know if it's going to be the bottom from the standpoint of the long term, the rest of the year or even in the next few years. But I do think that we're setting up for at the potential of maximum fear. We have a Fed that has committed to fighting inflation. They said that they would be data dependent, and a lot of people took that last time to mean that they were willing to pause if the data showed that that inflation was actually cooling off, and obviously that has not. And so gone are the hopes for September pauses, and now you're starting to see the market pricing in the fear that the next rate hike, which is going to be on Wednesday next week. The FOMC is meeting Tuesday and Wednesday, and there's a lot of speculation that they will hike even higher. But I think the most important thing is, if you go back a couple of meetings, I don't have it pulled up, so I apologize. I'm kind of just floating around in my DXY chart here. But I think the thing that is important to remember is, I think at the last meeting, or perhaps the meeting before, I can't really remember, there was a press conference. It actually might have been not an FOMC meeting. It might have been just a different occasion where Chair Powell was speaking, but he talked about the Fed being willing to take rates beyond neutral. And at first the market didn't notice that, and then eventually it did. And I think that now the market's going to have to come around to the reality that I think the Fed is going to try to fight inflation for far longer than most people think. So with that really long intro, we'll take a look at a couple of the markets, a couple of the charts here. And the first thing I wanted to do is start on the DXY, and I'll also look at the yield chart here, which, by the way, the 10-year yield closed higher than it did on May 6th, where a lot of people were saying that the yields were going to peak. A lot of people were convinced once we got this, even though we didn't close lower, we wicked lower than where we were on the 26th and 27th of April. A lot of people were saying, oh, we're on our way down. If you follow this channel, I put this trend line here, and obviously we broke that. What I wanted to point out to start with, other than that, if you pull back and you just pay attention to the fact that the trend is up, clearly up on both, and I've talked about this previously. People are always, when the trend is up, people are always looking for the top, and when the trend is down, people are always looking for the bottom. And in this case, I think it's important because all along here, all along this decline, if I actually, let me just make sure that everybody knows where I'm going right here. This decline right here, almost entirely down days, and any solid green days like this one on May 18th were rapidly sold the next day. A lot of people saying, "Oh, the dollar topped." I even entertain this a little bit. The idea that this structure kind of follows more like the Wall Street cheat sheet, sort of a blow off top sort of scenario. And obviously, this could still roll over. I don't think it's going to, but you still could roll over before making a higher high. I do think it's interesting that we got close. Obviously, these were two really big up moves yesterday. The ECB, basically they didn't come out as hawkish as I think the market was anticipating, and so what should have been maybe perceived as hawkish news, hey, the ECB is going to stop their purchases eventually, they'll raise rates. What should have been at least sort of hawkish is actually really dovish, because they're not actually going to be reducing their balance sheet anytime soon. I don't know when or if they ever will. And they're not really in a good situation to be able to do that. So, in any case, the DXY went up, 0.75% almost yesterday, and then a 0.85% move today. So the move actually accelerated, and so and that was obviously on the news of the CPI today. I wanted to show you the DXY basket here, because if you actually see here, this is the euro. And the euro chart here is inverted because I want all of the US dollar pairs the US dollar to be on top of all these pairs. But what you can kind of see here is over the week, obviously, all of the US dollar pairs were up substantially on the week. And what I thought was really interesting was, I've been tracking this on the Japanese yen for some time. The yen had started to turn. I think actually, if I pull this back a tad, let me see if that will work. I was pointing out that previously, when the yen turned and the US dollar yen pair started accelerating, or I should say decelerating, during the pullback, that was the sign that the dollar was going to cool off, and I wondered if that was going to happen again this time. And obviously, the yen pair with the US dollar took off first. And then what I thought was really interesting was, so the CPI, you can clearly see on the right side of the screen where my crosshair is, right around the time where the CPI print came in, about 8:30 a.m. Eastern time. And what you actually notice is in all of these charts, let's see if I can do this here. In all of these charts, you actually see movement. The move starts actually overnight before the actual CPI hits. I think that's really interesting. It's like as soon as, midnight Pacific time, 3 a.m., Eastern time, as soon as that comes around, you actually see price beginning to make the move. It doesn't always do that. I just thought that was notable this time. And then obviously you can see right here when the ECB came in with their when they came out with their policy decision, and Christine Lagarde came out and gave her press conference, you could see the DXY move right there, showing up most in the euro, but also even in the Canadian dollar, even in the Swedish krona, which I guess shouldn't surprise me, and then the Swiss franc. I thought that was really interesting. In any case, the dollar is strengthening again. It's just a stone's throw away from its multi-year high. I think it will break it. And the other thing I wanted to point out, going back to what I was getting ready to say earlier with the DXY and yields, the 10-year yield, is if you just look at this line, this kind of light blue line that I have here, that's the 50-day moving average. It's a simple moving average. And it's pretty standard on when you have a break to the upside and you get a really sustained move. It's totally common for price to come back and test that as like just a typical mean reversion. And it did that. It did exactly that. And now we're back off to the upside. And I just want to point out also exactly the same spot that we bounced off of from previously. So I wouldn't say that this is sometimes it's 50% or so. Like, so last time we got to here on the yield. And obviously this retrace is not 50%. But sometimes it is, sometimes it isn't. But the point is that oftentimes the 50-day simple moving average becomes that place where there is some kind of like correction that it falls down to before resuming up. And so obviously yields continuing to the upside, CPI showing you that inflation has not peaked, and that's obviously even just the number they tell you, and not really even the official number. So that's the first thing that I wanted to take a look at. And on the news, actually, interestingly, yesterday, price was holding up, and then just in the last few hours of the trading, the price came off really hard. So if I go to a 1 hour chart, you can actually see here, just in the last 2 hours of trading on the S&P on Thursday the 9th, you actually see price come off real hard. And then today, as soon as the CPI happened, you just saw it sell off like crazy. And you see that same structure take place on all of the indices, as you can see as I cycle through them. And so we've obviously come down. Let me go back to my S&P 500. Actually, on the S&P, we're closing right at about the same low that we had made on the 19th and 20th of May. So the question is, going into next week, are we going to move lower? I think we will. I think this bounce is over. Maybe it's an overreaction, but I suspect the bounce is over. A lot of people were talking about how this kind of area, and you can do the same thing on all of the indices. So I'm just going to kind of just show you the range, or the ranges, I should say. You kind of saw this kind of consolidation as the markets were, and the Russell looks a little bit different. But you kind of saw this consolidation as we were waiting to see what the Fed was going to do. And obviously, or not what the Fed was going to do, what the ECB was going to do, and then obviously what CPI was going to look like. The FOMC is next week. So, having said all that, obviously the market has chosen its direction, and I suspect, especially because if you look at the candles, the selling accelerated, and this is kind of why I'm saying I think we might be entering a situation where, kind of to what I was saying just when we were looking through this list right here, that it's entirely possible that the market is going to overprice or maybe underprice what the FOMC meeting is going to result in. I think that, they kind of talked about taking 75 basis points off the table or anything higher than 50. So I think it's going to be 50 still. I think they are too concerned about causing the market to turn down even more. And so what I think is happening now is a lot of fear is being repriced into the market. And what I think is going to happen is, going into next week, we're going to sell down. We might even sell down really, really, really hard. And if we get enough really bad selling days, then I could totally see us getting quite a bit closer to this kind of green support band right here that I have still on the S&P. Maybe not, but I could totally see us getting closer, at least dropping another 100 or 200 points easily next week. The other thing is, you have options expiry. You have the VIX options expiring on the same day that the FOMC meeting is taking place. So a lot of things that could potentially cause a significant amount of volatility in the markets. So just something to really be aware of. But I think it's entirely possible that over the next week, over the first couple of days maybe of next week, as we see the market pricing in the possibility of the Fed doing even more things, I think you're going to see some selling the first couple of days. And then I bet, I could be wrong, but I bet there's going to be a bounce Wednesday or maybe Thursday, because sometimes the first move on Wednesday is wrong, is the wrong direction. So we'll definitely see, but just really quickly looking at the indices, I want to put up the SAMS indicator. we closed back down bearish, and I think that it's really important to recognize that on these indices, you can see this down arrow. It's part of something I've been working on building into the indicator. When that arrow is red and pointing the same direction as the trend, it's not good. You don't want to see that. And so we got that red down arrow everywhere. And so it's kind of a volatility filter. And so it's suggesting that the volatility is going to maybe the best way to say it is the volatility is going to compound the situation, and potentially induce more selling in this case. And so that's part of the reason why I kind of have that outlook that we're going to get some pretty significant selling into next week. So let's shift over and look at the gold chart. It was really interesting, actually. Let's go to the 1 hour chart, because on the CPI news, it was really interesting. We got a really big 1 hour red candle the hour before the CPI. Then during the CPI, a really volatile, like wide candle, and then another red candle down. And a lot of people were saying, "What the heck's going on? Why is gold acting that way with the CPI print what it was?" And then we just had these really monstrous 1 hour green candles, and but then I mean, it's hard to get excited about that. I think maybe some people did, but it's hard to get excited because it's still below 1875, which is currently the level that I'm watching right now. But one thing I wanted to mention is this long-term trend line, which I've brought up a bunch before. Price, the wick goes down really far, but obviously closed above it, and I think that that's a good thing. I think that the fact that right here, kind of in mid-May when we came below that trend line, that there was a lot of potential for things to go really wrong on the gold chart. But the fact that it came back above, so this is a fake breakdown. Okay, it's not a I mean, just a fake breakdown, and so I think it's possible that we might start seeing some good price action in gold. What I'm going to be watching is this convergence area right here, where we've obviously got the horizontal resistance, we've got the trend line resistance right here, and then we've got the support trend line right there. And I'm going to be watching that spot to see what happens, what kind of resolution we get to that. The oil chart having a little bit of a pullback here, not too big, nothing out of the ordinary, but you can see there's just this clear, like just incredibly steep. I can't even draw it correctly on the on the pen tool, but you can just see that trend again after back over here saying we were going to consolidate and then go back up, and that's exactly what we've been doing, although it is happening quite a bit faster than I thought. You can just see that the rate is continuing to increase, essentially almost going parabolic, so it's definitely something to watch, especially something to watch as we get up close to kind of where the closing high was. And so obviously that's going to provide a little bit of resistance. So I could totally see us going sideways for a little bit before breaking up. But ultimately, it's going to go, right now, it's going to go one direction. And I think that that's up. And I mean, not a rocket scientist. I mean, that's just kind of pretty clear right now. So I can't take credit for having any sort of, groundbreaking, mind-blowing view on that. Okay, and then we'll take a quick look at Bitcoin and then get out of here. Holding up, interestingly, it reminds me of the Russell chart. Let me go back to the Russell chart. You can kind of see that even though we've had some pretty negative days, the Russell hasn't made a lower low since May 11th. And on a closing basis, May 27th, obviously here, May 11th and May 12th were the lowest wicks in this range. I have a whole bunch of different trend lines here. I was watching a bear flag. I was watching a sideways triangle with different trend lines kind of all over the place. I do think if I kind of darken this one, you can kind of see I had this as well. We failed to get above that. Let me darken that back out. I don't want that there. And I still feel like we've got one more leg lower, at least in the near term. And then maybe we get a good bounce. One thing interesting to point out with Bitcoin is that we get in July, coming in July, I think it's the first or second, well, maybe the second week of July, we are supposed to get a decision on the Grayscale ETF application. So it's going to be something to watch for. If you actually like look where I've got this, these gold boxes, the bottom one is from the old all-time high kind of area, and then the middle one here is where I see the most likely support, and that's actually where the 200-week moving average is starting to come up into. In Bitcoin's history, let me put the log chart on. Let me do a 3-day here. In Bitcoin's history, every time it crosses the 100-week, it ultimately always touches the 200-week, and so I think that's why I'm more and more convinced that we're going to go down there. We may not, but definitely got to be prepared for it. But that's why I have those boxes there. And if you look at it, like these boxes are starting to get really close to July. So I'm not saying that it's going to coincide well and the ETF may get denied, but I do think it is something to watch for as a possible where the possible bottom might take place. Because obviously, if that gets approved, that's going to bring a whole new level of interest, and I think that that could be a catalyst for something really big. Because obviously, if you pay any attention to the on-chain stuff, I don't really too much, but the one thing that's definitely being shown by on-chain is that there's a significant amount of supply that is not available. So we've got all the makings of a supply shock, but we just need a demand catalyst. Got to have interest, got to have people wanting it. And I don't know, who knows, an ETF might be the thing that causes that. So definitely something to watch. And then the other thing I wanted to do really quick is I wanted to just show you the cross pairs between the Australian dollar, New Zealand dollar, and the Swiss franc, Japanese yen. So you can see Australian dollar, Swiss franc, Japanese yen, the top two, and then the bottom two are the New Zealand dollar versus those two currencies. And they early on in the week were showing strong in favor of Australian dollar, New Zealand dollar, but they have been coming off in spite of the fact the Japanese yen has been very weak. They're coming off actually and closing the week very, very close to unchanged. And so I think that that's something interesting, just given how weak the Japanese yen has been, to see that it's still holding up pretty well against commodity currencies and the risk on currencies. And so I think that that's definitely something I want to keep watching. But that's kind of what's going on. That's my analysis for this week. Thank you again for watching. Make sure that you hit that like button and subscribe and share it with somebody if you think it was helpful and you think somebody else will find it helpful. And I will see you guys next week. Hope you guys have a great weekend.